The topic of my talk today is looking at the supply chain, not in terms of its efficiencies or responsiveness, but how fragile it is. How does it respond to stress? Nassim Taleb came up with three classifications, and I added a fourth one. I realized that there was one missing when we do it in this 2x2 matrix. So vertical axis, you have downside or pain. So that's the impact of a positive or negative stress. So unlimited pain is really bad. Limited pain would be good. On the horizontal axis is where we show the upside or the gain of a negative or positive stress on the system. Limited upside or limited gain is bad because it means you're not capitalizing on cases where you end up selling much more than what you expected or getting much faster or more reliable supply from your vendors. Limited means you are not capitalizing on it. Unlimited is green because that's good. You are fully capitalizing on it. So the first type of company or supply chain is called fragile. So we're going to map out its stress response. So vertical axis, plus and minus impact. So that would be plus and minus impact on its, for example, its profitability. Left to right, horizontally is the negative stress and the positive stress. So what does a stress response look like of a fragile system, a fragile company, or even a fragile supply chain? It basically is concave stress. So you can see as the negative stress increases, it exponentially increases the harm on the system. Whereas as the positive stress increases, it gets very limited gain from it up to a point where it basically flattens out. And that kind of makes sense when you think about it. So think about a company that is capacity constrained. It sells 10% more, its profitability goes up. It sells 20% more, its profitability jumps up substantially. Remember that 1 to 10 or 1 to 20 ratio when we are selling more or getting higher prices, right? There's asymmetrical increases in net profit. But then we could sell 30% more and suddenly nothing happened. Why is that? Because we've hit some kind of capacity constraint. We simply don't have enough capacity to respond to the increase in demand. And that's where the limited gain comes from. Whereas you can imagine a company that loses 50% of its sale within a quarter or within a year, and it can literally go bankrupt. There's no limit to the pain. So fragile systems, they are harmed much more than by negative stresses than what they benefit from positive stresses. So when we kind of label them, we should put a sticker on them that says fragile. Please don't kick me around. What is the next classification? It's called robust. And a robust system has a, rather than a concave stress response, it has a sigmoidal stress response, like a kind of an S response. So you can see it's different from fragile in that this company has introduced some kind of mechanism that will limit the pain of a negative stress. But often those same mechanisms also limits the gain from positive stresses. So for example, if you have a mechanism where you can quickly lay off people when there is a downturn in the market, but then when there's an upturn in the market, it takes you much longer to get those people re-employed, you might find that you cannot fully capitalize on the positive stresses. But you do limit the harm of negative stresses. Another mechanism to limit the pain would be if I need 4 machines, absolutely need 4 machines to cope with the minimum demand, or I need 4 trucks to cope with the minimum demand, but my demand can be as high that I might need 6 or 8 machines or 6 or 8 trucks. A mechanism to limit the pain would be that I buy 4 machines or 4 trucks, but I rent the others in a way that I can quickly give them back if I don't need them. So these are mechanisms that I can put in place to limit the pain of a negative stress. There is a danger that rather than going to the top, which is robust, we go horizontally to a system which I call bipolar. What is bipolar? It has also kind of an S curve, a sigmoidal, but it's turned kind of 45-degree angle, which means it's put in mechanisms to fully capitalize when there is a positive stress. So imagine a sudden increase in demand. Imagine if you could immediately deploy capacity to be able to capitalize on that. But you struggle to get rid of that capacity. And as a result, when there's a negative stress, you could have unlimited pain. So this is definitely a type of a system to stay away from because it might initially show that this is much better until you get a negative stress and it becomes really bad and a company can shut down. So robust system, the label robust means it's not really harmed that much by volatility. Fragile systems are harmed a lot because they are harmed more by negative stresses than positive stresses. So as long as the stresses are random, fragile systems get worse and worse over time. Robust system stays the same. Bipolar might have periods where you're doing exceptionally well, massive profits, only for the company to close down in the next quarter. And we've seen that in quite a few cases where there's hyper growth and startups, etc., and we get these massive returns, and then suddenly there's a one negative stress or a series of negative stresses that compound. There's just no mechanisms to limit the pain of those, and suddenly the business is bankrupt. So what is it that we really want? We want to aim in this 2x2 matrix for that top right-hand corner. And this is what Nassim Taleb calls an antifragile system. Rather than a concave stress response, it's developed a convex stress response. It's put in mechanisms to limit the pain, but at the same time, it's also put in mechanisms to fully capitalize on the gain. So limited pain, almost unlimited gain. Obviously, there's never unlimited. It's always unlimited up to a point where you have to make some kind of big change or investment to continue to leverage or benefit from the gain. But I think that this is a really, really useful way of thinking about your own company, but also thinking about your supply chain. You can imagine we do this type of simulations using advanced full dynamic simulations, agent-based, discrete event-based, but you can even do this in a kind of a relatively simple Excel sheet. You basically put in your financials, your P&L, balance sheet, cash flows, and then you say, let me see what will happen if we sold 10% more. Let's see if we can predict how much will that impact my sales revenue, my variable cost, my operating expenses, my net profit. How much will it impact my inventories or investment? How much will it impact the multiple I can get on my revenues, if it's annual recurring revenues, or on my EBITDA, if there's no annual recurring revenue? And then we do it at plus 20% and plus 30 and plus 40%. But then we repeat the exercise with minus 10, minus 20, minus 30. And that's how these curves are generated, is horizontally, you're going increased levels of negative stress, and to the right, you go increased levels of positive stress, and you see how it will impact the company in terms of profitability or ROI. It gives very, very insightful information. And if you find yourself that you are fragile, you definitely want to move towards robust rather than bipolar. Once you're already robust, you want to try to move towards antifragility. These are systems that get stronger and stronger over time. They're kind of like our bones, right? When we break a bone, when we tear a muscle, it doesn't only recover to the previous baseline. It almost like adds something so it can get stronger and be more prepared for the next crisis. I am deeply concerned with what I see with the aftermath of COVID, that many companies and industries hasn't learned the lesson to build not just robust, but anti-fragile supply chains. So that's the question, is how can we do that? The good news is there's precedent. There's a number of different companies that have already done that. And essentially, to move from fragile, not just to robust, but to anti-fragile, you need to develop, first of all, mechanisms to limit the pain from negative stresses. So in that case, for example, if you need between 4 and 6 trucks, don't buy 6, buy 4 and rent 2. If you need between 4 and 6 people, employ 4 and hire on a contracting basis the additional 2, so that you are not caught up and stuck with a lot of capacity that's not needed. Look at different mechanisms of working with your suppliers and customers, sitting down with them at least once a year and say, what are the type of negative stresses that can take place? When it happens, how can we make sure that we are not experiencing massive pain, especially when we're considering things like the bullwhip effect, where suddenly consumers start buying 5 or 10% less, and before we know it, there are no orders on the factories anymore. The factories look at this, they panic, not realizing that drop in consumption, the real consumption is only 5 to 10%. They think that consumption has dropped completely, and they start closing down production lines. And then when the demand comes back, they're simply not ready to capitalize on them. So you need mechanisms to limit the pain from negative stresses. You also need mechanisms to fully capitalize on the gains. So those are the two major insights. So let's have a look at some examples. the first example that I'm personally aware of, and that sort of dates me, is back in the early 1990s, one of the first companies that implemented theory of constraints was a printed circuit board manufacturer called Zycon. And they implemented theory of constraints that helped them to increase the throughput through their factories by a substantial amount, 30 to 40%. It helped them to reduce lead time substantially and responsiveness substantially. Also helped them to reduce overtime, avoidable overtime, and inventories. So they were producing more faster with lower cost and lower investment. Massive boost in profitability. But they were noticing something, that their customers were not all price sensitive. There were some customers that were very time sensitive, not necessarily on all their orders, but on some orders. So essentially they discovered that there's for the customer, there's a cost of having a printed circuit board, and then there's a cost of not having it. So what they did was they fully capitalized on the operational improvements that theory of constraints delivered for them. And essentially what that meant was everybody else was quoting 4 weeks lead time. What they did was they said, we will supply you in 4 weeks at the standard price, but we guarantee 100% due date performance. And that allowed them to gain quite a bit of market share. But then they said, if you need it in 2 weeks, we will absolutely commit to 2 weeks with the same guarantee, but we want an increased price. They tested out various pricing increases in different markets. In some cases, they were able to justify a 20% increase. In some cases, not having a printed circuit board and having the factory waiting because you are just waiting for a PCB was so dramatic that they could increase their price by 200%. So essentially double the price for half the lead time. And then they took it one step further and realized that there are some cases where the customer needs it not just in 2 weeks, but faster than that, 1 week or less. And again, they tested price increases there and found out that it varied from 40% to about 400%. So 4 weeks, 100% guarantee, every day that we late will pay a penalty. 2 weeks, absolutely can do that, same guarantee, but for double the price. 1 week, same guarantee, if we late, we'll give you a discount of, I think it was in the region of about 10 or 20% discount per day. So if you were more than a week late, they would basically get the product for free. And that dramatically increased not just the profit margins on ROI for Zycon, but it also made them anti-fragile. They were much, much more inclined to benefit from the natural volatility. Uber is another great example. As you know, the mechanism that Uber has got in place to limit the downside is that they don't own the assets. They don't employ the drivers. So when there's a downturn, those drivers that really don't need to be driving can stay at home. There's no real big downside to Uber. At the same time, they have a mechanism to fully capitalize on an upturn in the market, which is surge pricing. And that does two things, is when you are increasing prices during a situation where your demand exceeds capacity, it is a very fair way of prioritizing. It essentially says, normally my trip here in Las Vegas to the airport is maybe $25, but during peak time, it could go up to $50. I can make a decision. If I can wait, maybe another 20 minutes, it will drop down to $30 or $25 again. Whereas if I can't wait, I'm going to miss my flight, I'm quite happy to pay the $50. So increasing the price when demand exceeds capacity is a great, fair way of doing priorities, because you don't want a situation where suddenly demand exceeds capacity. The last time the customer placed an order on you for 100, you were only able to ship 50. And now the next time they need 100, they're going to place an order on you for 200, making everything worse because you have now no idea what is the true demand. So increasing pricing is a practical way of preventing that vicious cycle from happening. But in the case of Uber and many others, the increased price when shared with the drivers or when shared with your vendors can also be an incentive to increase capacity very, very quickly, again, allowing you to fully capitalize on the upside. Alibaba, when you're comparing them to a company like Amazon, Alibaba is definitely more anti-fragile because they do not keep their own inventories. So they have a mechanism that protects them against downside that is much more stronger than what Amazon has got. Amazon has gone the route of increasingly managing their own inventories, which they can generally do better than their suppliers, but it's still a big risk for them if suddenly the market drops, that they will be stuck with a lot of, not just inventory, but a lot of distribution capacity. YouTube, very simple, very similar. not spending any money on creating content, getting other people to do it for free, and just benefiting from the upside on that. So if suddenly, for whatever reason, there's a dramatic reduction in people watching YouTube videos, YouTube is not going to be stuck with a huge amount of overhead that might threaten the survival of the company. Fiverr is another one. Airbnb is another one. Jindal Steel and Power is one of our recent clients. And what we've done for them is we've introduced our supply chain digital twin as part of their sales and operations planning decision support. So on a monthly basis, they are doing something that I haven't seen any other company in their industry doing, which is essentially getting their sales and marketing teams to put in the level of expected variability in both demand and supply. So they might say for a specific product or product category, the minimum that we will sell because we have contracts is say 100, but we could sell up to 400. So that gives you your solution space that you can explore with optimization engines. So you can run optimization algorithms and then test those algorithms in a simulated world to see which product mix for the next month is going to be the most profitable. But what they could also do, and they are starting to do that, is why could we not, similar to Uber, use our stock levels as a fair way of controlling flow through pricing? So when we notice that for a specific product location, our stock levels are running very low, we automatically increase the price with a very fair and transparent rule set so that only those that really need the product will actually buy now. And at the same time, it provides that upside incentive to ensure that you do have substantial or enough protective capacity, not just yourself, but also your suppliers, if you are willing to share that benefit with them. So it's a very exciting development. Another company that's really interesting to look at is WiseTech Global. They are the company that supplies SaaS software for the freight forwarding and logistics industry, like FedEx, and DHL uses them. It's a company that also, at its foundation, Richard White, its founder, built the company on the principles of theory of constraints, and they've also embedded this antifragile system within WiseTech, and their financial performance is a good proof that it's working. They have sales of about $1 billion, but their market cap is $45 billion. So 45x their revenues, never mind their EBITDA. So these are some examples. Today, digital twins can be integrated directly with your ERP systems like SAP. You can create these supply chain digital twins like the ones that we've developed instantly from data that's sitting in the IT systems. You can bring in not only all the parameters, but also all the variability, uncertainty, etc. Build a digital twin and use the digital twin to answer a number of different questions. Design questions like, what is the optimum supply chain design? Where should we have factories or distribution centers or service centers? What's the optimal order fulfillment strategies by SKU location? You don't have to just come up with one and apply it to everything. You can treat every SKU location uniquely and say, this SKU location should be made to stock or finish or assemble or cut to order, or should it be make to order or even engineered to order. You can also find the optimal inventory management rules. So should it be forecast driven or demand driven? And if demand driven, which one fits our conditions the best? You can also use it for profitability analysis, comparing different product mixes and different buffer locations to find out what's the most optimal wall or the most optimal sourcing. Should we be making or buying? Should we be owning the transport, or should we be renting the transport or leasing the transport? Put in all the options, run the simulation and see which is best. But it also can help us to make much more reliable commitments regarding financial performance and operational performance. So I'll end off with some just key insights. To become anti-fragile, you need a mechanism to limit the pain of negative stresses. You need mechanisms to fully capitalize on the positive stresses, and mechanism and courage to discard parts that are just not contributing enough. So I hope that was valuable. I hope that I've challenged you to think about where you should be focusing your scarcest resources, your limited management attention and budget on, and hopefully identified some interesting high leverage points that you could capitalize on.